Okay, so today, the topic we have in front of us is IAS 36 on impairment of assets. IAS 36 on impairment of assets. That's the topic we want to look at. So we have observed that in recent diet, the interest of ICANN has been awakened to this topic. And considering what is happening right now in the macroeconomic environment of Nigeria, most of what is happening can also be an indicator of impairment. So to a large extent, we would expect that this diet again, ICANN is going to ask a question on impairment of assets because they just want to be sure that you are able to apply whatever is happening in the economy to your financial reporting or your reporting as an accountant in practice. So let's see how we can practicalize IAS 36 as efficiently as possible, and so that we can end up this class on a very good note, and we'll be moving to something else next week. So again, what we have in front of us is impairment of assets. And majorly, in this standard, what we are supposed to know, of course, the objective and scope of IAS 36, then more importantly, is how to identify that an asset has been impaired and how to measure recoverable amount, then recognition and measurement of impairment loss, then cash generating unit and goodwill, then reversal of impairment loss, then disclosures. Okay, so this is what the syllabus of IAS 36 wants us to know. So the first one that talks about the objective and the scope. So the objective majorly is just how to determine impairment. How do you know that an asset has been impaired? And also, we will be learning how to determine recoverable amount and some other key things that this objective is talking about. But you would appreciate this objective after we have properly looked at the main content of this standard. And IAS 36 deals with impairment of assets. However, there are certain standards like IAS 13. This impairment of assets standard in IAS 36 does not apply to IAS 19. And it does not even apply to IAS 12, talking about deferred tax assets and some aspect of financial assets, because there is a standard IFRS 9 that deals with impairment of financial assets. So there are some aspects of financial assets that are dealt with by the standard on financial instruments. And also there's a standard called IFRS 5 on non-current asset held for sale. IAS 36 does not apply to this standard also. So these standards have actually been scoped out from IAS 36. So there are certain definitions that are also relevant, but I want to move in explaining these definitions as I progress in the core topic, so that it will make more sense to us. So the first thing that I want to start with critically is identifying a potentially impaired asset. So the first thing we're going to look at is, how do you determine that an asset has been impaired? So the way we determine that an asset has been impaired, this standard calls them indicators of impairment or impairment review. And before I look at these indicators of impairment, I want to pay or you bring your attention to this asset part. When we say impairment of assets, you see, the assets we are focused on in this standard is non-current assets like PPE, intangible assets, majorly those non-current assets, or maybe even investment property. But the focus here is impairment of non-current asset. Okay, so I was talking about how do you know that an asset has been impaired? So we call that indicators of impairment. So when we talk about indicators of impairment, there are external indicators and there are internal indicators of impairment. The external indicators of impairment, these are indicators that are outside the scope or outside the control of the company. The company cannot control it because it is outside their scope. And one of them is that when there is a fall in the market value, when there is a fall in the market value of an asset, majorly. So that could be that, okay, maybe this asset has been impaired when there's a decline in the market value of an asset. Another one is that when there is a change in technology or probably technological, market, legal, or economic environment of the business in which the asset operates. So the key thing here is that when there is a change in either technology, either economic environment, either market, and all of that. So if you have an asset and there is a new technology that introduces an upgrade to that asset that you have, there is likelihood that that asset might have been impaired. There is likelihood that that asset might have been impaired. So if there is a change in technology or if there's a change in economic environment, like what is happening in our country now, where almost the macroeconomic indicators are elevated, like inflation is elevated over 31%, talking about the core inflation. Interest rates is elevated. So you're all aware, CBN just increased the NPR by another 200 basis points again recently. So all these are changes in economic environment, and they can indicate that your assets might have been impaired. You would understand that very soon. And another one is increase in interest rates. Increase in interest rates. Like the example I just gave you now, CBN has increased NPR, interest rate. So for you to really relate with this interest rates, there is a figure we usually use it to calculate, which is value in use. And you see, the higher that interest rate, because that interest rate, we use it as a discount factor. And the higher these interest rates, the lower the market value, or sorry, the lower the value in use of that asset. The lower the value in use of that asset. So since if the value in use is low, then there is high likelihood that there might be impairment. So another external indicator is where there is an increase in interest rates that is used in calculating value in use. Another one is that where the carrying amount of the entity's net asset is more than its market capitalization. This will apply to entities whose shares are quoted on the stock market. So if their market capitalization, which is their share price multiplied by the total number of shares they have on that stock market, if it is lower than the book value of the assets, of its net assets, if it is lower than it. So if the carrying amount of the entity's net assets, if it is higher than its market capitalization, then there is high likelihood that the asset might have been impaired. So these are external indicators of impairment. They are really variables that are outside the scope of the entity, like a fall in the market value. An entity does not have control over selling price or market value of an asset. So if that fall, then there's likelihood that your asset must have been impaired. Another one is that a change in technology, market, legal, or economic environment that could also impact on whether your asset has been impaired or not. Another one is an increase in interest rates. And finally is when the carrying amount is more than market capitalization. These are external indicators. And the internal indicators that your asset must have been impaired is one, if there is a physical damage or obsolescence of that asset, or where there is an adverse change in the performance of the asset. An asset that used to do 10,000 units per day before can now only do 5,000 units. It might show that the asset is weak and is impaired. And another one is where there is a reduction in the expected useful life of that asset. Okay, so these are indicators of impairments. Your exam have asked it severally. They could ask again. So another way they could ask it is that you should identify or you should do an impairment review. Okay, so when we say impairment review, what they are asking for is that you should identify indicators that show that there is an impairment of an asset. Now, we have talked about indicators of impairment. So the key question should then be, when is an asset said to be impaired? Where is an asset said to be impaired? So the first thing I will tell you about that is that when we talk about impairment usually would mean a permanent loss in the value of an asset. And when I say in the value of an asset, I'm talking about the book value. The amount you have in your books is what we are referring to. So if you have an asset in your book at 50,000 naira, there is an impairment if you cannot recover that 50,000 anymore. That what you can only get is something less than 50,000. And that is why when you look at this first definition, talking about impairment loss, he said that an impairment loss is the amount by which the carrying amount of an asset exceeds its recoverable amount. That's an impairment loss. So whenever the book value, which is the carrying amount, when it is now higher than what you can recover from that asset, that shows that that asset has been impaired and there is an impairment loss. Because if your book value is 50,000 and what you can recover is now lower than that, then that means the asset has suffered impairment. So all of you here should know what carrying amount is, which is the book value, which is usually cost minus accumulated depreciation minus accumulated impairment losses. And that will apply if the entity is using a cost model. But if the entity is using a revaluation model, then the carrying amount would be fair value minus subsequent accumulated depreciation minus accumulated impairment losses. But if an entity is using a fair value model, then carrying amount is just fair value. So that is the carrying amount, majorly the value in your books. However, recoverable amount from the name, it means how much you can recover from an asset. And recovering from an asset would either be from the continuous use of that asset or from the sales of that asset. So recoverable amount is the higher between how much you can get from either selling an asset or continue to use an asset. And that is why the definition here for recoverable amount is that is the higher of the fair value minus the cost to sell. So which is like net realizable value and its value in use. So the higher of the two is recoverable amount. So what is fair value? Fair value, you can take it as the selling price of an asset. You can take it as how much you can sell, how much you will receive when you sell an asset. Value in use, you can take value in use as how much you would get from continue to use an asset. That's the value in use. Okay, so, but for you to know how much you will get from continue to use an asset, that would have to do with a lot of estimate because you are talking about the future. That if I continue to use this asset, how much money can I make? How much can I recover? So for you to know the value in use today, you would have to make some estimate of future cash flows. And when you make estimate of future cash flows and you need a value today, so you have to do some discounting to today's value. You will see how we're going to address that. But don't forget, everything I want to teach you today is all around these definitions here. That when is an asset said to be impaired and how to calculate that impairment. And from here, you will see that the core thing, the basic underlying principle in IAS 36 is that an asset is said to be impaired when you cannot recover your book value. And in a more structured way, we will say that when the carrying amount is higher than its recoverable amount, when the carrying amount, which is the book value, is now higher than its recoverable amount, that goes to show that in one way or the other, you are overvaluing your assets. You are carrying a figure as your asset more than what you can recover from that asset. So we really want you to bring the asset down so that whatever you have in your books at any point in time will show actually what you can recover from that asset. And that is the underlying principle in IAS 36. So knowing fully well that carrying amount is book value, the recoverable amount is how much you can recover either from selling or from continue to use an asset. From selling, they will call that fair value. From continue to use these assets, they will call that value in use. And that is it. So by the time we put figures to all of this, you would see what we are talking about clearly. So now, if that is impairment, then we have also looked at how do you know that the amount you are carrying in your books is higher than what you can recover. Then that was what led us to these external and internal indicators. And like I've told you earlier, based on what is happening in the economy, we expect that a question on impairment should come out because elevated inflation, elevated NPL, naira devaluation, all this goes to show that you are overvaluing your asset. All this goes to show that maybe your asset might have been impaired. Maybe your asset might have been impaired. And also, you will see the current pronouncements by CBN on recapitalization of banks. This goes to show that they want banks to show the actual value of what they have in their books, that what they are having, they can't recover it. So for them to be able to sustain their business, they said you need to inject more capital into this business. All these are happening in the macroeconomic environment. Okay, so let's come down to what we are doing. Now, don't forget that you know what impairment loss is, which is when carrying amount is higher than recoverable amount. And we have looked at how do you know that an impairment has occurred, which is by looking at external and internal indicators. Your examiner can call these indicators of impairment, they can call it impairment review. Okay. And this impairment review, it's something ordinarily should be carried out periodically. It could be maybe every year, it could be every 2 years, it could be every 3 years. So it depends on the entity. And you see, by the time you do an impairment review will now tell you that we can see, based on the fact that CBN has just increased interest rates, we might be overvaluing our assets. It's an indicator, right? So when you see that, then the next thing is now to confirm, because our book value, we will know that one, but we need to know how much can we recover from these assets. As soon as there is an indicator that shows that this asset might have been impaired, whether external or internal, then the next thing to do is to now then confirm how much we can recover. So you see, that process of confirming or calculating the recoverable amount, we call it impairment tests. Okay, it is the process that involves calculating the recoverable amount. So that is when you now look at, okay, what is my fair value? What was the fair value now? What is the value in use now? Then when you get that, the higher of the two becomes our recoverable amount. Then when you now get your recoverable amount, then you can then now do a comparison with the book value, which is the carrying amount, to see whether the book value is higher than that. Then we will know that, okay, your asset might have been impaired or not. However, you see, when it comes to impairment tests, it's not something you will do annually. It could be every 2 years, it could be every 3 years, depending on indicators, right? So, but there are certain assets that you have to test them for impairment annually. And one of those assets is an intangible asset with an indefinite useful life. When you have an intangible asset that has an indefinite useful life, then that has to be tested for impairment annually. And also, is you have goodwill that is acquired in a business combination, like the one you lent under group account. In fact, that's the one we are talking about here. Goodwill must also be tested for impairment annually. So you already know how to determine impairment loss from what we have said. It's just comparing carrying amount with recoverable amount. So calculating impairment loss, we'll call that measuring. We'll start with, how do you measure your recoverable amount? So I've already explained that already. That is the area of the fair value. And if there is any cost to sell, you remove that. Then you compare that with the value in use of that asset. So that gives you recoverable amount. Then whatever it is, compare your recoverable amount with the book value. So let me show you this to practicalize all I've said. So there's a company that has a machine in a statement of financial position at a carrying amount of 150,000. The machine is used to manufacture the company's best-selling products range, but the entry of a new competitor to the market has severely affected sales. As a result, the company believes that the future sales of the product over the next 3 years will be 75, 5,000, and 25. The asset will then be sold for 12,500 eventually. We're now told that an offer has been received to buy the machine immediately for 120,000, but the company would have to pay shipping costs of 25. The risk-free market rate of interest is 10%. An impairment review confirms that the asset might have been impaired. Determine the impairment loss. Okay, so determining the impairment loss, like I've mentioned, is just comparing the carrying amount with the recoverable amount. And the first step is to determine the carrying amount, which mostly they will have given you. In this case now, they give us a carrying amount. And in another cases, which I've not seen, they might break down this carrying amount into cost and accumulated depreciation. So it is now left to you to determine the carrying amount yourself. But here they gave us. Now, then the next thing is now to determine that, okay, how much can you recover from these assets, which is the recoverable amount. And the recoverable amount is the higher between the fair value and the value in use. So from here now, this paragraph, they told us the future sales of the product, 75, 50, 25, and they will eventually sell the assets eventually at also 12,500. You see, this is just telling us how much the company will make from continue to use this asset. So all these variables or figures will help us in determining value in use. Let me quickly show you how to determine value in use. So because what they gave us are future cash flows. Year one, at the end of year 175 from the question, 50 year two, 25 year three, and they also told us that they will sell the asset eventually at 12,500. So all these are cash inflows. Okay. So there are some exams. I've seen a question whereby these cash flows, they gave you this one, and they also give you, I think, net of tax. They gave you the cash flow that they have not deducted tax, right? And they gave you the cash flow before tax and cash flow after they have deducted tax. So what is important is how much you are going to make. So it's really, if they give you that kind of scenario, that means it's the net cash flow you will use, which is cash flow after they have deducted tax. If you have that kind of scenario. So whatever adjustment, if the examiner wants to go that route, is ultimately the net amount you would make. That's what we are interested in here. Okay. But yeah, this one is straightforward. They just give us the cash flow straight. So now, because these are future cash flows and we need a value for today, so we need to discount all of them to present value. The examiner gave us a discount rate of 10%. So using discounting factor of 10%, using 1 plus r raised to power minus n. So for year one, it will be raised to power minus 1, raised to power minus 2, like that. And it's 10%, that's why it's 1.1 plus 0.1. So these are the discount factors. So when you multiply each of these discount factors with the cash flows, that gives us the present value. So when you have the present value for each of those years, you cumulate them together, it gives you your value in use. So we have our value in use as 137,678. So having gotten the value in use, then the next is to determine the fair value. And the fair value, we're told that they can sell these assets immediately for 120,000 naira. 120,000, but they will incur shipping costs. So that means the fair value will be like a net realizable value by getting the fair value of 120,000 and deducting the cost of selling. Then ultimately we get 117,500. So we have gotten all our variables. Our recoverable amount is the higher between this net realizable value and value in use. And from here is the value in use that is higher. So in summary, we will now compare this recoverable amount, which is the higher of the fair value less cost to sell and the value in use. We'll compare it with its recovery, with its with its carrying amount. And you will see here that this company in its books have a carrying amount of 150,000, but it can only recover 137,000. That means one way or the other, what is carrying in his books is higher than what he can recover. So that means there's an impairment loss of the difference. So impairment loss will just be 150,000 minus 137,678, and that gives us 12,322. Okay, so impairment loss is really not beyond this. It's not beyond this at all. You're just getting recoverable amount and value in use. It's never going to be beyond this. Then the next thing you should know is when you have an impairment loss, then how do you, like this 12,322 now, because that's what this section 4 is talking about here. How do you then recognize it in your books? I mean, you should by now, with all the topics or standards we have looked at in this class, you should know that this impairment loss will be recognized in P&L through like a debit to P&L. But where will the credit go? Automatically, the credit will eat the assets so that it can come down to its recoverable amount. And it's no more than that. But you have to be very careful, right? For a situation where there is an impairment, but it is an asset in which there was a previous surplus, there was a previous revaluation surplus. If that is the situation, then this impairment loss is you will treat it exactly like evaluation deficits. That means that evaluation deficit or impairment loss, you will not take it to P&L straight because there is an earlier surplus. If there is an earlier surplus, then you just take it to OCI to go and nil off that surplus first. You take it to OCI to nil off that surplus. Then, and that's how you're going to treat that if there is an earlier surplus. Okay? But really, for impairment loss correction, you see that maybe they want to focus on the impairment loss. But in case they tell you that on this asset, there was an earlier surplus, that's the only situation where this impairment loss will not go to P&L, that it will go to OCI to net off against that surplus. And that's all this one is talking about. And really, that is the entire story around impairment loss. So we should just end the class now, but we can't because there are certain assets. There are certain assets that it might be difficult for us to get their impairment loss because we might not be able to get their recoverable amount. For example, now, let's say air conditioner in an office, for example, now. How would you know that an air conditioner has been impaired? Okay, so again, looking at the figures, we will know our book value for the AC. But how do we get our recoverable amounts? IAS 36 says that recoverable amount is a higher between the net realizable value. For AC, I think we should be able to get the net realizable value. The challenge becomes the value in use. Value in use. Value in use is how much you would make from continuing to use that asset. That's value in use. So how would you know how much you would make from continuing to use an air conditioner? Except we want to make assumptions is practically difficult. And not only is air conditioner alone, there are other assets like furniture and fittings, like laptop, like elevator, like a lot of assets within companies that you might not be able to determine their value in use. Majorly their value in use. Because those assets, looking at them individually, they do not generate money. So you cannot attribute cash flow to them that, this is how much I will make from using these assets. And that is why we have to talk about cash generating units. Because by the time you put those assets together and see them as one. Like, for example, now, instead of looking at air conditioner, furniture and fittings, elevator, looking at them as different assets, is it possible that you look at the entire building, for example, and see it that, okay, this entire building, how much are we making? That you would be able to have an idea of how much you would make. So there are some assets that you cannot determine their value in use. Please don't forget this. The only reason why we are even talking about this cash generating unit is coming up. Ordinarily, I've taught you impairment loss. I've taught you how to determine it. But the only reason why we are coming up with this cash generating unit is that practically there are some assets that you cannot determine their value in use, which is how much you would make from that asset. And if you cannot determine value in use, that means there is no way you want to determine recoverable amount, because you have to consider those two. And if you cannot determine recoverable amount, that means there is no basis for determining whether the asset has been impaired or not. So the standard says that when you have that kind of challenge, then you need to group assets together. And the standard defined cash generating unit as the smallest identifiable group of assets that generate cash flows largely independent of the cash flows from other assets or group of assets. So you have to identify what are the group of assets that generate cash flows together. Then you put those ones together, then you'll be able to get how much money again going to make, then you'll be able to get their value in use. Okay. And there is a question here that I just want to teach us or make us understand cash generating units. So it talks about minimums belonging to a retail store chain Maximat. And they said Minimat makes all its retail purchases through Maximat Purchasing Center. And I said the pricing, marketing, advertisement, and human resources policies, except for hiring Minimat cashier and salesperson, are decided by Maximat. Maximat also owns 5 other stores in the same city as Minimat and 20 other stores in other cities. All stores are managed in the same way as Minimat. Minimat and 4 other stores were purchased 5 years ago, and goodwill was recognized. What cash generating unit does Minimat actually belongs to? Okay, so this entire question is just talking about supermarkets that Minimat belongs to retail store chain Maximat. So it's just like if you know, let's say Ebano. So let's just see Ebano supermarket as Maximat. So they have different branches. So let's just see one of those branches as Minimat. So they now went ahead to tell us that it's Maximas that advertise their markets, that do human resources for the entire company. And so that's just, they're not asking us that is Minimat a cash generating unit. So to answer that, the question is that can Minimat make money? When all is provided to Minimat, when all is provided, before you can even talk about making money, at least it has good marketing is going on and all of that. So if Maximat has provided all he needs to provide, can Minimat make money on his own? Yes, it can. Okay, so as long as Minimat can make money on his own, therefore, Minimat does not belong to any cash generation units. Minimat itself is a cash generating unit because it's a supermarket. It's just a branch. It makes money. People go in, will be buying stuffs. Okay, so we can see that as a cash generating unit. So this question is just going further to tell you that a cash generating unit can be like a segment of a business. So the whole idea of cash generating unit is just a group of either a group of assets or a branch or a segment of a business that can make money on its own, that makes money, that you can say that, okay, this is how much this segment has made this year, something like that. Okay, so that's that. Now, So again, don't forget, what brought us to cash generating unit is just the fact that some individual assets you might not be able to determine their value in use. So cash generating unit would help. But even at that again, the challenge still becomes that when you check your books, it's not like you will see an asset in your books called cash generating units. So cash generating units will just only help us in determining value in use. Then from there, you'll be able to get fair value. Then you do a comparison. Then you'll be able to get impairment loss. So the thing is that the impairment loss you now get, how do you then know which assets? Because the impairment loss is like impairment loss belonging to the CGU, because you will have gotten a value for the CGU, which contains, like, will have contained many assets. You will have compared that with the carrying amount of those many assets, right? So when you now get an impairment loss, you have to attribute that impairment loss to those individual assets. So even when cash generating unit eventually helps us determine the impairment loss, we still have to allocate that impairment loss to individual assets. And that's the next thing I would be showing you here now. So when you have that, okay, let me use this question to explain that. Then we'll talk about this. Let me use this question so that you would see what we're talking about. So this question goes through that there is a cash generating unit and it comprises of the following assets. So building, plants, goodwill, and current assets. So all these assets put together, the question is clear. I mean, it told us that, okay, cash generating unit. So these values they give us obviously will be the book value. These are the book value. Then I said, following a recession, an impairment review has estimated the recoverable amount of the CGU to be 25 million. Okay, so this question is also very liberal and very gentle. So it has given us the recoverable amount. So we don't have to stress ourselves in comparing value in use and fair value, looking for the higher and all of that. So they has given us recoverable amount of the CGU. So this recoverable amount of 25 million is for this entire group of assets, which is CGU. So then I said, how do we allocate the impairment loss, which is what I need to explain to you. So the first thing is this: since we have recoverable amount of the group of assets or of the CGU, and we also have the carrying amount of the group of assets. So getting the impairment loss is not difficult. So the impairment loss is simply the carrying amount, which is 33 million, minus the recoverable amount, which is 25 million. Obviously, here there is a loss because you are carrying your asset above what you can recover from asset. So we are having a loss of 8 million naira. We're having a loss of 8 million. Okay, so this 8 million, like I mentioned earlier on now, it belongs to this group of assets. Belongs to this group of assets. So and in your books, building is separate, plant is separate. So you need to find a way to allocate this 8 million to these assets individually. So how do we do that? So there's an order. There's an order here. So when you want to allocate impairment loss to CGU, the first is to allocate it to a damaged or destroyed asset. A damaged or destroyed asset. If there is anyone, the question will tell you. In this question now, we don't have any damaged or destroyed assets. If there is, we'll allocate impairment loss to that first. Okay, and it might be the only one that will gulp everything. Depends. I will show you very soon. Then, if by the time you allocate the impairment loss to a damaged or destroyed assets, then we go to goodwill. if there is goodwill in the correction, then you allocate impairment loss to goodwill. That's the next. Then you allocate to all other assets in the CGU on a pro rata basis. On a pro rata basis. Okay, so these are the steps which we'll solve few questions on so that you will get it widely. So the question becomes, okay, why are you allocating impairment loss to a destroyed asset first? I mean, if you remember internal indicators of impairment, one of the internal indicators is that when an asset is damaged. So why they are allocating impairment loss to this one first is because it might be the reason why there is even an impairment in the first place because of a damaged asset. So that's why we allocate to that first. Then the second one is goodwill. So goodwill is seen as like a good name, like a reputation, like quality of customer service, stuff like that. And it seems to be highly volatile. A singular action of a staff of an entity can destroy that goodwill, right? So, which is why we are allocating impairment to it next, in the sense that even if there is a damaged asset and we have impaired that, if impairment loss is still remaining, we believe it should be goodwill that should suffer that because we believe it's highly volatile. And if there is still impairment loss, then you give that to other assets on a pro rata basis. So you see how this works. So let's start with this simple question. So here now we have gotten an impairment loss of 8 million. And in this question, we don't have damaged assets, but we have goodwill. Okay. So this is how you would do the allocation. So we have the book value. I have my building, the book value was 15 million. Then my plant, the book value was 3 million. My goodwill, the book value is 5 million. My current assets, the book value is 10 million. So I said that when we need to share this 8 million, because this 8 million was determined using CGU, we need to allocate it to the individual assets. So first to goodwill. The value of the goodwill is 5 million, which is lower than the impairment loss amount. So that means we can fully impair this goodwill. In fact, we can fully impair it. So the carrying amount after impairment is 0 for goodwill. So after fully impairing this goodwill, because we believe that that's what will have given rise to the impairment loss. Okay, so we allocate it to that. After you have impaired, remove 5 out of 8, then to be remaining 3. Then since, and that 3 is that it will be to other assets in the CGU on a pro rata basis. So pro rata basis is on a proportionate basis. And how does that work? So the remaining 3, this is my workings here, showing how I shared the 2. So I actually shared it between building and plant and machinery. I did not share it to current assets. Reason because when I was going to start this topic, I told you that IAS 36 focuses on impairment of non-current assets. So usually when you have current assets like trade receivables, like inventory, they are really outside the scope of IAS 36. The only time where you would even consider current assets is if the examiner tells you that this asset has been impaired also. But if the examiner is silent, like in this question now, they didn't say anything about the current asset. They just said it's part of the CGU. Then don't impair it. Don't. We believe it's not, it has no impact here in IAS 36. So, and that is why we did not impair these current assets. So that remaining 3 million, we will share between building and plant and equipment. For the building, I did 15 over 18. And how did I get 15 over 18? The value of the building is 15 million. The value of the plant is 3 million. Okay, so I'm like doing 15:3. Okay, so, and I want to share 3 million. So I will just do 15 over the cumulation of these two, which is 15 plus 3. And that's how I did 15 over 18 times 3 million. Then for the plant and machinery, I will do 3 over 18 times 3 million. It's like I'm using their value like proportionately to share the remaining impairment loss. So if you do this math calculator, the building gives 2.5 million. The plant and machinery gives 0.5 million. So when I go to my table, for my building, I put 2.5 million. For my plant and machinery, I put 0.5 million. So after applying the impairment loss, what is now my new carrying amount? So the carrying amount after impairment loss for the building will be 15 minus 2.5. That will be 12.5. For the plant and equipment, it will be 3 minus 0.5. That is 2.5. Then the goodwill is 5 minus 5 is 0. The current assets impairment loss was not allocated to that. So 0 is still going to be 10. And those are my carrying amount. And that's how you allocate impairment loss to a CGU. Okay, so before I move to another question, one additional question. Do we have any observations yet before I move to the next one? Any observations? Okay, so there is this question that I want us to look at. There are two questions here. Both of them are technical. So there is this one that we'll look at now, and there is this other one. There's this other one here. Is similar to that too. So I'll just try any of them, then you go and try the next one. I've sent you the solution along with it, but let's look at this one first. So this question says that as a result of privatization and commercialization exercise currently going on in the country, the Ministry of Transport sold the assets and liabilities of the newly constructed Standard Gauge Railway to a private company known as Stalos Railway Limited to ensure smooth operations of the railway's services by freeing it from government bureaucracy. Okay, so let me just analyze this first paragraph. So the Ministry of Transport sold a railway to a company, and that's that in this first paragraph. So the second paragraph, and I said the summarized extract of the statement of financial position at fair value. Okay, note this, at fair value of SRL on January 1st, 2019, reflecting the terms and conditions of the sales agreements of the ministry are as follows. So they gave us the assets at fair value of SRL, of that the company that acquired the railway. So, however, they also gave us the purchase consideration, 2.25 million. I want to believe that will be the addition of all of this. If you add all this together, that will tell us, just telling us like, okay, what's the value of this company, which is the fair value of the assets. Okay, let's look at the next paragraph. We're told that the operating license, I'm sure they are referring to this, so they want to give us more information. So the operating license is for a 10-year period, which was issued on 1st January 2019. Okay, that means they just got the license because this financial position itself is 2019. Okay, by the transport ministry, and it is stated at costs. Okay, so they say that this license is at cost. This one is at cost. Okay, so they now say the carrying value of the property and rail tracks are based on value in use. Okay, so the property and the rail tracks, they said this value are value in use. Okay. All right. And they said the engines are at selling price. So 2 engines, they said this 750 is selling price. So this paragraph is just trying to define the values here. So they told us that this operating license is the cost. They said this property and railway track, they said, yeah, this is value in use. They said these engines, these 2 train engines, that is net realizable value, selling price or fair value. Okay. So all that information were given on January 1st, 2019. Okay, let's go to the next paragraph. Then I said on February 1st, 2019, that's another month entirely. Okay. They said one of the train engines got damaged. Wow, damaged. Due to a technical from the manufacturer, and the engine was completely destroyed. Okay. We shall know that they have two train engines. So only one got damaged, no problem. Then I said the sale of the asset to SRL was without recourse to the Transport Ministry. So that means that SRL cannot go and meet the ministry and say that this train you sold to us is not good, or give us our money back. Say that one cannot work. They say it is without recourse. So they have bought it, nothing. Okay. And that's all this one is telling us. That okay, one of the train engine has been damaged. Okay, let's go to the next paragraph. They now said, in view of this, it was estimated that there would be a reduced passenger capacity. Therefore, the estimated value in use of the old train services business of SRL was assessed at 1.5 billion. Okay, so they are giving us the value in use of the entire train. So that goes to show that they are seeing this entire train as a CGU, because we can see that this license now, you see, they told us that it is at cost. That means they don't know the value in use. This train engine now, they said it is, this value is its selling price. That means they don't know their value in use. Though they know the value in use of the two, which they gave us, but there are some other assets in which they don't know their value in use. That's why they are now giving us their value in use as one. So they are for them to give us this, they are seeing everything as a single asset. So I can say that this 1.5 billion, 1,500 billion is the value in use of the CGU. Now, the last paragraph. When I told that the number of passengers after one of the engines of the train got damaged was below expectation, even allowing for a reduced capacity, in the light of this, the value in use of SRL rail services was reassessed as at March at 1,350 billion. On this date, SRL received an offer of 675 billion from another company called Papaya for the operating license. Since it's transferable, the realizable value of other assets has not changed significantly. Okay, so we don't know whether SRL will now sell it to Papaya, but I mean, they have now given us the net realizable value of the license. Okay, you are required to draft a memo addressed to the MD of SRL explaining the basis of allocating an impairment loss to the asset of a CGU in accordance with IAS 36 on. Okay, so even this, to answer this one, we don't even have to read this question. That's draft a memo to MD of Star Loss explaining the basis of allocating impairment loss. We don't have to read this question. And the solution of that is here. So to allocate impairment loss is you of course get the impairment loss first and allocate it to a damaged asset, then to goodwill, then to other assets on a pro rata basis. Then I give you some extra information here that that's and that this allocation should be majorly for non-monetary assets, like I was telling you, non-current assets, except where the examiner tells us that monetary assets, I'm talking about current assets. If they tell us that, okay, they are not exempted, or they have to be specific around those ones, that's when you will be allocating impairment loss to those ones too. And here they are talking about when you impair an asset, make sure that the value is not below the recoverable amount. That's what this guy is saying here. Do not bring it down to below recoverable amount. You rather bring it to its recoverable amount, not below it. Okay. Okay. So that for this A part. So this one is quite straightforward and it's 6 marks. But when they say draft a memo, that means you have to make sure it's a memo from the accountant to the managing director. Then you put the subject, the basis of allocating an impairment loss to asset of a CGU. Then you write the letter properly. Then you close it. Thank you. Then your name, your designation, like that. Then the B part says that we should calculate the carrying amount of the assets of SRL Limited as at February 1st, 2019 and March 1st, 2019 for 10 marks. Okay. So at February 1st and at March 1st. Okay, 2 separate periods. And if you look at this question, truly, as at February, they gave like a use. As at March, give us another value in use. So that means different impairment loss for those periods. So let me page paragraph it like that. Let me put a space. So let me do this February 1st first. Okay. So for the February 1st, we need to calculate what is even the impairment loss before we now say we want to allocate. So I will see this as my book value, because this is the amount this company paid for this asset. So this is the book value. This is the amount at which they will be in his books. And they already gave me the value in use of the CGU. So I can easily get my impairment loss for the entire assets. I can get my impairment loss for the entire asset, which is the addition of this 2.25 minus this 1.5. Where's the book value? Did remove the value in use. So that will give us like an impairment loss of 750. So let's now calculate the carrying amount of this as at February 1st, 2019. When they say carrying amount, that is the value after you have deducted the impairment loss. So let's look at this. So this was the value in the balance sheet in the books. So this is the carrying amount as at January 1st, 2019. When this company bought the railway, the goodwill was 150, the license, like that. So the total was 2,250,000. Now, the impairment loss was 750,000, like I've explained that to you already. So how do you then allocate it? Don't forget, the way we allocate first to a physically damaged asset. So between January and February, because we are calculating this at February, this first one that they asked us to calculate, this impairment loss, or this carrying amount, was there any damaged assets? So yeah, on February 1st, one of the twin engines got damaged. Right, and there are 2 twin engines here. So since they didn't tell us how we should separate the figures, so I'll just share it equally. if we do 750 divided by 2, that's like 375. So that means one twin engine, 375, second twin engine, 375. So now one has been damaged. That means out of that impairment loss of 750, first, I will allocate 375 to these twin engines because one of it has been damaged. I will allocate 375 to this one first. So that one is gone. Out of 750, we have removed 375. Since there is no other asset that was damaged as at this February, it was only this twin engine, then the next asset I will allocate impairment loss to is goodwill. Goodwill. Going back here, my goodwill is 150. So out of 750, I've only allocated 375. So it's still remaining like another, it's still plenty, but this, you can, well, whatever is remaining, can allocate in 150, we can swap this 150. And that's why we allocate 150 here also. So what is remaining, now that we have allocated out of this 750, we have allocated 750 minus 375 minus 150. So it's remaining 225. Okay. So this 225 now, we are going to share it to the remaining asset on a pro rata basis, and the remaining asset are the license, the station, property stations, and the road tracks. So let's see how we'll share it. And it's going to be on a pro rata basis using these their values. These are carrying amount. So let's go to our workings. So for the operating license, I will just do 900, which is the value of the license, over the addition of the value of the three assets. Okay, multiply it by the 225. I just intentionally break it down, which is 750 minus the 375 we allocated to the engine, minus 150 we allocated to the goodwill. Then if you do your maths, 900 over the addition of the three assets that we want to prorate, that we want to allocate the remaining impairment to. Don't forget to, this 900, 225, 25, these three assets remaining. And that's why we do 900, 225, 225. You can add them together. So it's 900 divided by these three, multiplied by 225. That will give you 150. So that means operating license will allocate 150 to it. And if you operating license, we give it 150. Then the property stations, that one is 225, which is the value of the property station over the entire value of the asset multiplied by 225. Then that's 37.5 billion. So we allocate 37.5 to the property. Then to the road tracks, 225 over the total value multiplied by 225, which is the remaining impairment loss. Then that also gives us 37.5. Then you come here and allocate 37.5. So we have allocated the entire 750. So after we have shared this 750, then we can then get what is my remaining carrying amount. So 150 minus 150, 0. 900 minus 150, 750. 225 minus 37.5, 187.5. 225 here minus 37.5, 187.5. Then 750 minus 375 gives us 375. Then, of course, brings the value down to the value in use of 1,500,000. And that is that one. Okay. Any concern here? So the only observation I would have expected you to make is this, if you understand what I've been talking about since, is that when I allocated 375,000 to one of the train engines that was damaged, then to goodwill, I now shared the remaining three. I now shared the remaining 225,000 impairment loss. I shared it among these three assets. I would have expected somebody to ask me that, what about the remaining one train engine? Why are we not allocating further impairment to that one also? Because that is also remaining assets. Okay. So there is ordinarily you should have allocated. The only reason why I haven't allocated it is this, and it's a very critical point, is this. We're told up here that the engines are valued at their net selling prices. Net selling prices. For that reason, except that the asset is damaged, the carrying amount will not come below the recoverable amount. The
We
essence
can
of it.
hear you, sir.
Oh, can you hear me now?
Yes, sir, I can hear you now.
Oh, okay, okay. So I was trying to explain why the remaining one train engine now. Because only one was damaged, and we don't allocate further impairment loss to the remaining one. So I'm saying the reason is because, can you still hear me, please?
Yes, sir.
Okay, so the reason is because they said the engine are valued at their net selling prices. Okay, and the essence of impairing is to bring the carrying amount to ensure that is at its recoverable amount, which is the higher between value in use and fair value or selling prices. So if the question already gives me the net selling prices of an asset in a CGU, we don't expect that the carrying amount should not go below that. In fact, the easiest way for you in the exam is that whenever they give you selling price of an asset in a CGU, don't further impairing that asset. Don't further. Because that means if you impair it further, that means the value will now go below. It cannot go below. It can only go higher. Because that's the essence of impairment. That's the essence of everything we're talking about today. Ensuring that the value you put in your books reflects the recoverable amount. So if the question tells us that one of those assets is already at its recoverable amount, so there's no point impairing it. So the only reason why we allocated this entire 375 to one of the train engines is because it was damaged. It's because it was damaged. So that remaining one that was not damaged, you don't touch it because it has its selling price. It already has it at its recoverable amount. So it is where we want it to be. And that's why this 375 remains. Okay, so I needed to clarify that. Now, we have done a part of it. So that will have earned us 5 marks. Going back to the question, so they asked us for the carrying amount as at February 1st, 2019, and also as at March 1st, 2019. So we have done February 1st. So now let's do March 1st.
Right. Please, I have a question.
Please ask.
Okay, so let's assume the train engine was not at net selling price, or let's assume it's not at net selling price. So like you said, we can split it into two equal parts, and the one that is damaged will fully impair it. Then the second one, are we going to prorate it as we prorated the other
No. Okay.
asset?
Yes. We would have created it.
Okay.
Yes. We will have created it.
Okay, thanks.
Yeah. Okay. So, yeah. Now, let's get that of March. Now, to get that of March, since we now have a new value in February, so that means we'll continue from February. Then, so for March now, the figures in February, I'm bringing them down here. Goodwill is now 0, so I'm starting from operating license, property, road tax, and the remaining one twin engine, whose value is 1.5 million. So let's see what happened in March. I think it was this paragraph. So what happened in March is that they gave us a new value in use for the entire CGU, which is the train station, which is good. So we can already visualize the impairment loss, because that means our book value now is 1.5 billion. But now they give us that the recoverable amount which is value in use is 1.3. So that means we need to write down that 1.5 to this 1.350, so that there will be an impairment loss of like 150. Also, we're told that in 2019 that the company received an offer for the license. Okay. That goes to show that this question is indirectly giving us the net realizable value of the license. They didn't spell it out like that this is the net realizable value, but they said they received an offer from another company that they want to sell it, and the company is ready to pay 675. That means this is the selling price of that license. Now they have given us the selling price of that license. So that means just go and put this 675 as the new carrying amount. You cannot impair it below this 675, just like I've explained earlier to you. Since I've already, so let me show you. Where is the second one? Okay. So now the second for March, now we start from the values as of February. These are the values. So the book value was 1.5. The value in use was 1,350. So there's an impairment loss of like 150, the difference of that two. So let's share it. So here now, we don't have any damaged assets. Okay. And we don't have goodwill. We don't have damaged assets, we don't have goodwill. Okay. So ordinarily, we should just prorate this 150 among all of these assets. But you'll be very wrong if you do that, because we already know that the train engine, this 375 is selling price. So that means you cannot allocate impairment loss to that. Just bring this 375 here. Don't allocate impairment loss to it at all. Secondly, this license of 750, they already told us that somebody is ready to buy it for 675. That means the new value in your book should be this is the recoverable amount. So just get the difference, 750 minus the 775. So that means you can say that it has been impaired to the tune of 75. If, for example, now this selling price, I'm just saying, for example, if they are told us that somebody is ready to buy it for, let's say 500. Let's say 500. That means 750 minus this 500 will have been 250, which is higher and above the 150. Right? I'm just giving an hypothetical example that the examiner will not give you. So that means you cannot come and put 250 here. Since this is 150, the maximum you can give it is the maximum impairment loss we have. But that question is not logical enough. But I mean, you get the idea of what I'm talking about. You cannot share more than what you have as impairment loss. So here now, since the question told us that the selling price of this license is 675, so that means the difference between that and this book value is the extent to which we can allocate the impairment. So now that we have taken 75 out of the 150, that will remain 75. Then that will share between these two guys. So since we know that these ones is book carrying amount, they didn't tell us the selling price, so we can allocate it on a pro rata basis, and that's what I have here. 187.5 divided by the additional 187.5 multiplied by 75. That gives us 37.5. Since they are the same figure, the same thing, 37.5. So we allocate 37.5 here. We allocate another 37.5 here. So by the time you remove these impairment losses from these book values, then we have our new carrying amount as this. Then totally it gives us 1,350. And that is it for this question. So
Please, I have a question.
oh yeah, please ask.
Yeah, so concerning the training, okay, the train engines, right? You mentioned in the first solution, you said the reason why you didn't impair it was because it was mentioned in the question that the value is the selling price as at February, sorry. Then as at March, I don't know, the question also said that's the selling price at March 2019 because you didn't also impair it during March.
Yeah, a good question. So the question did not mention that to us, but that's what it is. They don't have to change it. Since they didn't mention otherwise, we cannot assume that it is not the selling price again. Since they already told us that, okay, this value is selling price, that means it's the selling price. All true. You cannot assume another, except the examiner, like this, for this license now. In February, they told us that it was costs. If you look at this one, they said the license, where is it? Yeah. It stated that costs. They said the operating license is at cost, right? And in March, they came and said somebody wants to buy the license, and they gave us selling price. So that one now it's clear. So there was a change in from cost, now it's not selling price. But this one, they just say that the train engines is at their net selling prices. And they didn't tell us any otherwise. So we assume it's still their selling prices.
All right, thank you, sir.
Yeah. Any question? Okay, so again, impairment loss is quite straightforward because all you just need is carrying amount which the question will give you compared with the recoverable amount. So the asset is impaired when carrying amount is now higher, then that's your impairment loss, right? So it's ordinarily straightforward. So one other question I've seen in your exam was that they gave you a pre-tax cash flow and a post-tax cash flow. I mean, what you need for and that's when they give you cash flows, future cash flows. I mean, it's basically for you to get value in use. So whatever value you are going to use must be the net, because the idea of value in use is how much money you can make from continue to use these assets. So it's the post-tax cash flow that you will have used. Okay, after you have paid all your expenses, tax, everything, what's remaining? Okay, so that question, if you're going to check May 2023 or November 2022, that was the day they asked that. Okay, but I would still share it with you as a classwork. So, but it's a very straightforward question. A more advanced question are where they now want you to, they will group assets together. They will give you a singular value for recoverable amounts, and they will ask you to calculate impairment loss. So that means they are referring to CGU. Now, when you get the impairment loss, you need to allocate that impairment loss to individual assets. So you have to remember that order. That order is very important. That the order is that first to damaged asset, if any, next to goodwill, if any, then you share the remaining. Now, even when you are sharing the remaining, I've mentioned some key things. Number one is this: if they give you selling price of any of those assets, please don't allocate impairment loss to that asset too. Because if you do, that means the value, you'll now be getting a lower value, like a value lower than its recoverable amount. So when they give you selling price, don't bother yourself allocating to that one, which we have seen from this question. Another one is if they give us current assets like trade receivables, inventories, current assets generally, don't impair those ones too, except the examiner specifically tells you that this one also has been impaired. Then you can then consider it. There's a question like that you see where the examiner specified that, okay, there's this current asset has been impaired. If they don't specify, don't even bother allocating impairment loss to it. Okay, so that's that for this this question. So there is one more, and this is on reversal of impairments. The question asks us the conditions that must exist before impairment loss can be reversed. And this one, the conditions is not far-fetched, right? Because when you say reversal of impairment loss, that means the value of the asset has now gone up. An asset whose value was depressed initially, and you had to bring it down to a recoverable amount. Now, in another year or in subsequent years, the value it has increased in value. Maybe the economy has boomed and all of that. So it has decreased in value. So, I mean, if that happens, that's good. So just elevate the value again. That means you'll be having like a revaluation surplus. Okay. So that's why, and that's what this guy is asking you. And that's why my number one answer is that before you can reverse, there must have been an improvement in the indicators of impairment before you can improvements in the indicators. And what that is saying is that, okay, well, now the market value is now higher, so can you reverse? Another one is that when you reverse, don't reverse in such a way that the new value you are now getting is now more than the value in your books, even before the initial impairment. This is what we are saying. Before impairment even came on at all, let's assume that the value in your books was, let's say, 90. So impairment, you now shall impair, the value came down to 80. The value came down to 80. All we are saying is this: if for whatever reason they tell you that there's a reversal, meaning the value went up again, you cannot go up beyond 90. Even if the examiner says that the new value is 100, you have to restrict it to 90. Because we don't want ojoro, we don't want accounting shenanigans, right? We don't want people trying to create accounting. We believe that value should not be more than the original carrying amount before the impairment. And that's what this other condition is addressing. Okay, so there is this other question here. So let me give you a choice now, right? Because this is after 10. Should we solve this together, Wow? I give you as assignments.
Please, sir, can I ask a question?
Please do. Please ask her.
Okay, my question is this concerning what you said last, but please, can you scroll up? Can you scroll up, sir? Okay, as regards not reversing, so reverse not need to the carrying amount being in excess of what was there initially. Now, you
Yes.
see the example you gave. Maybe initially the carrying amount was 90, then there was impairment. The carrying amount is now 80, then there's a reversal. Maybe the new carrying amount is now 100, and we have to restrict it to the initial carrying amount, which is 90. So what happens to the balance of 10? What do you do with the balance?
You ignore it.
Oh, okay.
No,
Okay.
it won't go in there. That's a very good question. It won't just show in our books.